Well, the Fed's minutes from the June FOMC meeting show that the debate over whether to hike rates again or hold them steady was more intense than investors thought. Now, the probability of further tightening at the July meeting seems almost certain, with 95% of analysts forecasting a 25 basis point hike, according to their CME FedWatch tool. Our next guest sees a hike in July, with the Fed holding steady before cutting rates in the first quarter of 2024. But with new employment data showing resilience in the labour market, could the Fed go even higher? Well, joining us now is Sam Stovall, CFRA Research Chief Investment Strategist. Good to see you again, Sam. So I want to get your take on these numbers. On these ADP numbers, do you think this changes the trajectory for the Fed at this point?
Well, I think you're absolutely right that the Fed will be raising rates in July, and certainly, the stronger the data become, the greater the possibility that the Fed will go beyond raising rates in just July. Next week, obviously, we've got CPI, PPI data, so these inflation measures will either douse or fan the flames of concern regarding the upcoming and future Fed meetings. So right now, we're sticking with the forecast of a July hike, but then a pause, but obviously we are just as data dependent as the Fed.
And I mean, we got this unanimous decision to pause here, but then as we sort of dig into the minutes here, we see that there was a lot of disagreement behind the scenes. What do you think investors should take from that?
Well, I think what you take is that there wasn't a unanimous feeling, if you will, that the hawks really wanted a rate hike. The doves wanted a pause. In a sense, they opted for the dovish side, which means that they'll be giving it to the hawkish side in the July meeting. The real question is, will the data support additional hikes through the third quarter and possibly even further? So I think it all just depends upon how strong the employment data are for Friday. Our expectation is that it will come in around the 250,000 level, as well as whether we see a continued downstep in inflation readings in the coming week.
And so then for people who are wondering, as we're sort of getting ready, we've got the first half of the year behind us, going into the second year, potentially what this could mean for earnings, as we still see this uncertainty about how the Fed is going to proceed. What are your expectations?
Well, the expectations are not good for this second quarter. The bar is set very, very low, with 8 of the 11 sectors expected to post year-on-year declines. And right now, the S&P is expected to show an 8.4% shortfall from the same period last year. However, this is likely to be the trough quarter in this earnings recession. So investors could be, sort of repositioning themselves before the start of the earnings reporting period next week. Also, remember that expectations were for a pretty dismal first quarter, only to end up with a minus 1.2%. So investors were heartened by that. So I think we'll have to wait and see. But investors are more forward looking. So even though we also tend to see the markets decline in the third quarter, we could be setting ourselves up for a nice end of year rally.
And so what are some of the risks that you think are already priced in and some that investors really should be aware of in the back half of the year?
Well, when you look at a variety of historical measures, whether it's a 6.5% gain in CPI on a year-over-year basis, whether it's leading economic indicators in the red, or an earnings recession, an inverted yield curve, et cetera, they have traditionally pointed to a recession. But the recession just seems to be absent without leave at this point. And so investors are wondering, maybe it will get deferred until 2024. The real question then is, does this bull market fizzle out before recouping all that it lost in the prior bear market decline? We don't think so. We think that based on the 20% advance plus the more than 70% recovery of the prior bear market, that chances are we will recover its entirety. But then the question is, does this become a sort of short bull market because of a recession occurring next year rather than the expectation for this year?
So then, Sam, what sectors look attractive to you right now, and which ones are you steering clear of with that in mind?
Well, first off, we are not very short-term traders, so we're not going to be saying load up on the defensive sectors for the next 2 weeks and then rotate back into the more cyclical and growth areas. Our belief still is that the Fed is close to the end of its rate tightening program. Inflation will continue its downward stair step, and that the market does tend to recover nicely during that pause period for the Fed. So we have overweight recommendations, meaning over the longer term, for communication services, consumer discretionary, and tech, but we have underweight recommendations on consumer staples and healthcare.
We'll certainly be keeping an eye on all those sectors. Always good to have you on. Sam Stovall there, CFRA Research Chief Investment Strategist. Great to have you on Yahoo Finance.
Thank you.